Hello financial fans, welcome back to another stock analysis. Today we'll be covering RCI Hospitality Holdings, stock ticker RICK. RCI Hospitality Holdings is a company that runs and owns restaurants and nightclubs in America. Currently they're sitting at an 877 million market cap. They got a revenue of $267 million in 2022. Their dividend yield is currently sitting at 0.21%. Some of the clubs they run include Bombshells, Tootsie's, Scarlett's, and Downtown Cabaret. Their revenue is divided into multiple sections. The biggest part is alcohol at 42%. 50% of the revenue is generated by food. 36% is generated by services. And the remaining 7% is other revenue streams that they have. 79% from their income comes from the nightclubs, and 20% comes from the Bombshells. The remaining 1% comes from other places. To determine the intrinsic value of RCI Hospitality Holdings, we'll be using a margin of safety at the end of our calculation. The margin of safety will be determined based on financial ratios and the financial health of the company. To determine the margin of safety, we'll be using a scale. When we're using 4 colors in our scale, bright red will mean plus 5% added to a margin of safety, orange will mean no change to a margin of safety, light green will mean a 5% deduction from a margin of safety, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean 10% added to our margin of safety. Once again, orange will mean no change in our margin of safety. And bright green will mean a 5% deduction from our margin of safety. First financial ratios that we'll be looking at are the EBIT growth and the margin growth. The EBIT has nearly doubled from 2016 going to 2021. You can see in the COVID years, they had a big drop due to all of their clubs, nightclubs, and their restaurants closing. Even with this drop, they were still able to get a 50% average growth annually. This means 10% will be deducted from the margin of safety. Looking at their margin growth, also this took a big hit in 2020, but still has grown over the years. The growth here was 25.16% on average. Means a 5% deduction from a margin of safety. The next ratios that we'll be looking at are the dividend growth and the payout ratio. The dividend has gone up in a few steps, going from 12 cents a share yearly to 16 cents a share yearly in 2021. The growth on average was 6% annually, which means no change in our margin of safety. The payout ratio is currently sitting at only 4%. Which is in our green area of our scale, meaning a 5% reduction in margin of safety. The last two ratios that we'll be looking at are the debt to equity and the return on invested capital. As you can see, the shareholders' equity is larger than the liabilities that RCI Hospitality Holdings is currently bearing. It means that we'll be deducting 5% from the margin of safety, with a debt to equity ratio of 0.69. The return on invested capital currently sitting at just under 13%, which means once again a 5% deduction on our margin of safety. Let's go look at the valuation models next and see what the intrinsic value of RCI Hospitality Holdings is. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow of 2019, 2020, and 2021. Out of this, we got an average growth of over 75%. Since we'll be using the lifetime expected growth of RCI, I've gone with 20% of the average growth, coming in at just over 15%. With this 15%, we can determine the future free cash flow of RCI and their present value. Also, we'll be calculating the terminal year of valuation. This will be done using the perpetual growth rate and a discount rate of 8.5%. Combining the present value of all the future cash flows, we get a sum of free cash flow at just over $1.4 billion. To get our equity value, we need to add the cash and equivalents that RCI has on their balance sheet and subtract the total debt that RCI has. When doing this, we get an equity value at just over $1.3 billion. To get our discounted cash flow price per share, we just have to divide it with the shares outstanding, which is just over 9 million. When doing this, we get a discounted cash flow price per share at $141.08. With the current price at $93.78, we get an upside of $47.30, which is just over 50% upside. The next and final valuation model that we'll be using is the multiple valuation. In this model, we look at peers of RCI and look at their stock price, earnings per share, and then calculate their PE, price to earnings multiple. Out of this, we get an average PE for their competitors. Then we'll be multiplying this by the earnings per share that RCI is generating, and then the fair value will be determined. In this valuation, we get a fair value of $60.76. Finding peers for this valuation was quite hard, since no company that I could find did exactly what RCI was doing, but I've gotten some companies that I think do somewhat of the same business. With the current price of $93.78, the upside is not an upside but a downside of $33.02. This means a downside of 35.21%. Let's look at final overview of the valuation for RCI. Looking at the final overview, you can see we have imported the discounted cash flow price per share and the multiple valuation. We didn't do the discounted dividend since the dividend payment is quite small. RCI, at only 0.21%. Ignoring the discounted dividend, we get an average of $100.92 per share. We are going to be using the margin of safety that we have calculated earlier, which is 0%. This means the fair value will be exactly the same as the valuation models that will be used at $100.92. The current price of $93.78 is the upside of 7.61%. If you are ignoring the financial ratios and financial health method that we used, you can write on 30% there and see that the upside is no longer an upside but a downside of 24, just under 25%. If you like the video, please drop a like and let me know what companies you want to see next. Thanks for watching.